Two people, same starting point, same number sitting in a bank account, $5,000, 10 years pass. One of them still has roughly $5,000. The number on the screen held, but structurally, nothing changed. The other person's financial position looks entirely different. Not because they earned dramatically more, not because they took a risk that happened to pay off. The difference was not the money. It was the system the money entered. One person held a number, the other initiated an architecture. Most people approach $5,000 with the wrong question. Is this enough to matter? The honest answer is no, not by itself. $5,000 is not a fortune. It is not a shortcut. This video will not suggest otherwise. But there is a more important question, one that largely determines what the next decade looks like. What role should $5,000 play inside a properly structured financial architecture? That question is where the analysis begins. Before discussing how money should be positioned, it is worth understanding what happens to money that simply sits still. Most people think of a savings account as a safe place. In a narrow sense, that is accurate. The balance does not disappear overnight. But the financial system operates on a different logic than the number on a screen. There is a concept called purchasing power. It does not refer to the dollar amount in an account. It refers to what that dollar amount can actually buy. And purchasing power does not remain stable simply because a balance does. Inflation, the gradual increase in the general price of goods and services, has averaged roughly 2 to 3% annually in the United States over recent decades. That figure represents an economy-wide average. Individual experiences vary depending on spending patterns. Housing, healthcare, and education have historically risen faster than the headline rate, while other categories have moved more slowly. But the structural effect is consistent. To make this concrete, $5,000 a decade ago covered meaningfully more in everyday expenses, groceries, utilities, basic services, than the same nominal amount covers today. The number did not change. The purchasing power behind it did. Applied across a full decade, that erosion is not trivial. A balance earning minimal interest while inflation compounds steadily loses real value, quietly, invisibly, but measurably. This is not an argument against holding cash. Cash serves a critical and irreplaceable function in financial architecture, which the next section addresses directly. But it is an argument against a specific assumption that holding money in place is the same as preserving it. Inside the financial system, idle capital carries a cost. That cost does not appear on a bank statement, but it is real, and understanding it is the foundation of everything that follows. The first structural role of money, before growth, before investment, is protection. Most financial conversations move past this layer too quickly in favor of strategies and returns. But a system built without protective capital is structurally fragile, and fragile systems tend to fail at the worst possible moments. Life does not follow a linear path. Unexpected expenses arise. Medical situations, job interruptions, urgent repairs. When those events occur inside a system with no buffer, the damage compounds. Debt accumulates. Long-term positions get liquidated at inopportune times, and a financial structure that was slowly being built collapses under the pressure of a single event. The data reflects how common this vulnerability is. According to survey research, only around 41% of Americans could cover a $1,000 emergency expense using savings alone. That is not a character flaw. It is a structural gap, and one that protective capital is specifically designed to close. There are two distinct forms of protective cash worth separating. The first is operational, money that covers regular bills, monthly expenses, and the predictable costs of daily life. It needs to be liquid and accessible. Its function is continuity, not return. The second is a dedicated emergency reserve, capital held specifically to absorb financial shocks. Most financial frameworks reference 3 to 6 months of essential living expenses as a structural benchmark. Even 1 to 2 months of coverage provides meaningful resilience for someone earlier in their financial journey. Money held in this layer is not underperforming. It is doing precisely what it was designed to do. For that reason, many financial frameworks place protection before growth. Not because growth is secondary in importance, but because a system without a stable foundation cannot reliably sustain what is built above it. With a protective layer established, the next structural issue becomes visible, and it is one of the most commonly overlooked in financial planning. Many people assume the natural next step after building a reserve is to begin investing. But there is often a prior condition that quietly undermines any growth the system might produce. That condition is financial drag. Financial drag is any ongoing cost that extracts value from a system faster than the system can generate it. The most common form in personal finance is high-interest debt. The average credit card balance in the United States exceeds $6,000 per person, and interest rates on those balances have in recent years regularly exceeded 20% annually. That figure substantially changes the arithmetic of wealth building. Consider two parallel scenarios. In one, money is directed into a diversified long-term investment. In the other, an equivalent balance carries interest at 20% annually. Historically, diversified equity markets have produced average annual returns of roughly 10% in nominal terms, approximately 6 to 7% after accounting for inflation. That is a meaningful long-term return. But against a 20% interest obligation running simultaneously, the net effect in many cases becomes negative. The drag exceeds the growth. It is worth noting that this comparison uses long-run historical averages, not guaranteed yearly outcomes. Market returns vary considerably from one year to the next, but the directional logic remains. Few financial decisions produce a risk-adjusted outcome comparable to eliminating a high-interest obligation. Many sound financial frameworks prioritize removing drag before accelerating growth, not because investment is the wrong destination, but because building while another part of the system loses value at a faster rate works against the architecture as a whole. Stabilize, remove drag, then build. With protection established and financial drag addressed, the architecture is positioned to deploy productive capital. Historically, across many decades, broadly diversified equity markets have produced average annual returns of approximately 10% in nominal terms, or roughly 6 to 7% in real, inflation-adjusted terms. This is a pattern drawn from extended historical data, not a forecast, and it carries qualifications that matter. Markets do not produce consistent annual returns. They move in cycles, sometimes sharply. Severe declines, drawdowns of 30, 40, or 50%, have occurred at various points in history. Some recoveries unfolded over years. The historical record is not a smooth upward line. It is an irregular path with significant interruptions. Those interruptions are also what produce a common misconception that equity markets are structurally similar to games of chance. The comparison is understandable. Short-term price movements can appear random, and during periods of sharp decline, the experience of holding equities can feel deeply uncertain. But the structural comparison breaks down under longer-term analysis. Casino games are designed with fixed negative expected values for participants. Diversified equity markets represent fractional ownership of productive businesses across the economy. Over long time horizons, that distinction has historically produced a meaningfully different outcome, though without guarantees for any specific period. Volatility in this context is not a design flaw. It is the structural reason markets have historically offered returns above those available from low-risk alternatives. Risk and return are connected. Understanding that relationship, rather than reacting to short-term price movement as a warning to exit, represents a defining difference between short-term and long-term financial architectures. Capital deployed into diversified long-term positions is not a bet on a specific outcome. It is a participation in a mechanism that, historically and across decades, has produced growth, unevenly with interruptions, and without guarantees for any particular window of time. Here is where the architecture becomes more precise. Most conversations about $5,000 focus on the $5,000 itself, where to put it, how to make it grow. But that framing tends to miss the more important structural variable. The factor that most consistently shapes long-term financial outcomes is not the starting amount. It is the mechanism that feeds the system over time. Compounding, the process by which returns generate their own returns, is a genuine financial phenomenon. But its power is not evenly distributed. A single deposit of $5,000 invested and left untouched grows. In the early years, however, it grows slowly because the base producing those returns remains relatively small. What changes the trajectory is the consistent addition of new capital. Consider the difference between a single $5,000 investment held over decades versus the same initial amount combined with a regular monthly contribution, even a modest one. Over time, the second scenario does not simply produce incrementally better results. It produces a fundamentally different growth curve because each contribution expands the compounding base for every subsequent period. The returns begin compounding on a larger and larger foundation. Over long time horizons, the cumulative difference can be substantial, not because the monthly amount was large, but because it was sustained. This reframes the structural purpose of $5,000. Its role is not simply to grow in isolation. Its role is to initiate a mechanism designed to receive capital over time and to allow that capital to compound across long periods. The architecture that determines how much capital that system can receive over time is income. The most consistent driver of long-term capital accumulation is not investment selection. It is the capacity to generate income that can be directed into a growing system. Financial positions that develop meaningfully over decades are almost always supported by expanded earning capacity through skills, professional development, business income, or deepened financial knowledge. That allows progressively larger inputs over time. As income expands, the system receives more. As the system receives more, compounding operates on a larger base. The structure becomes self-reinforcing. The starting number matters far less than the design of the engine feeding it. No architecture eliminates risk. That point deserves directness. Markets fall, sometimes sharply, sometimes for extended periods. Unexpected events alter financial conditions in ways no model fully anticipates. Even well-constructed systems experience meaningful losses. Recovery is not guaranteed within any specific time frame. What a sound financial architecture does is not remove uncertainty. It builds a structure capable of functioning through it. Liquidity, the protective cash layer, allows the system to absorb shocks without forcing the liquidation of long-term positions at inopportune times. Diversification reduces the impact of any single failure within the broader system, and the behavioral capacity to remain positioned through periods of volatility rather than reacting to short-term price movements allows temporary declines to remain temporary rather than becoming permanent through premature exit. That behavioral dimension is where many structurally sound systems break down in practice. Financial outcomes over a lifetime are shaped less by individual decisions than by sustained patterns of behavior. Two people can hold identical portfolios and produce significantly different results based entirely on how they responded to the same market conditions. Those who exited and re-entered the market at various intervals in response to short-term volatility often experienced outcomes that diverge substantially from those who remained consistently positioned. Understanding the system does not guarantee specific outcomes, but it changes behavior, and behavior sustained across years and decades is among the most consequential variables in long-term financial architecture. Return to the beginning. Two people, $5,000, 10 years. The difference in their outcomes did not originate in the amount of money. It originated in the role that money played, in whether it was simply held or deliberately positioned as the first layer of a system designed to receive, protect, and grow capital over time. $5,000 on its own does not produce financial security. The leverage is not in the number. It is in the clarity of the structure surrounding it. Wealth, durable, meaningful financial position, does not begin with large capital. It begins with structural clarity. Knowing what each dollar is for, understanding where it belongs inside the architecture, and designing a system that can be consistently fed and sustained over time. The starting amount matters far less than the precision of the design and the consistency of the behavior that maintains it. Most people spend their financial lives asking a single question: how much money do I have? The structural shift, the one that separated the two people in this story, is learning to ask a different one. Where does this money belong inside my system? That question is not really about $5,000. It is about the relationship between capital, time, and architecture. And it is a question available to anyone willing to examine how the system actually works. That is where financial architecture begins. Financial method. We don't sell dreams, we explain systems.